I posted something on X talking about depreciation and that 100% is potentially coming back. And I had somebody say, you're a scumbag for that. Like, why are you going to just let an apartment become vacant so that you can capture tax help? That's not what depreciation is. So when you buy an apartment, parts of that apartment wear out. There's wear and tear. And as real estate investors, you're able to capture that depreciation over time. So for multifamily residential, your depreciation schedule is 27 and a half years. So let's say you buy an apartment building for $10 million. You cannot depreciate land, so you have to take the land value out. Let's say for this example, $3 million land value, which gives you $7 million of asset that you can depreciate over 27 and a half years. Math is simple. You divide 7 million by 27 and a half, which gives you about $254,000 each year to depreciate. This is why it's beneficial, because you are now showing a loss on paper, even though that loss isn't coming out of your pocket. And here's where it starts getting cool. If your cash flow from that property, let's say, is less than $254,000, well, does that show that you're making a gain or that you have taxable income? No. So if you're making $200,000 a year in cash flow and your depreciation loss is $254,000, you're not paying taxes on that. Or maybe the best way to say it from a compliance standpoint is you're pushing those taxes into a later date that you can have a strategy to ultimately avoid. So it's beneficial to do that. Now, in the TCJA, which is the tax cuts that came in 2017, 100% bonus depreciation came back into play. And what that means is in real estate, there's some items of your building that depreciate faster than 27 and a half years. Basically, there's some items that depreciate in 5, some in 7, some in 15. And what you're able to do as a real estate investor is do something called a cost segregation study. Basically, what that means, you hire a CPA, they go look at your building, and they find all the things that you can depreciate on a tighter window. And then when you're looking at your depreciation schedule, you're going to get a whole bunch up front, and then it'll continue out in a smaller scale or smaller number for the full 27 and a half years. So in a lot of cases, we have projects where we can get 100% of our principal investment in depreciation loss over, let's say, a 7-year window. But what 100% bonus depreciation lets you do is capture a chunk of that and take it all year one. So if we start going into what this means for 100% bonus depreciation, if it stays in this bill and passes the Senate, if we put a building into use for 2025, considering that this thing passes, because the building has to be in use, let's say the building is worth $36 million and the land value is $7 million. That would give us $29 million to depreciate. Now we do a cost segregation study, and let's say that gives us $6.75 million of assets to depreciate in 5 years. This is your fixtures, your equipment, etc. And let's say we get $2.5 million that we can depreciate in 15. That full $9.25 million could qualify for bonus depreciation. Well, that means that we get to capture the entire 9.25 in 2025. So that's huge. Now, as of right now, if 100% bonus depreciation doesn't come back, we can only capture 40% of the depreciation loss year one. So this is a significant additional amount of money. It's about $3.7 million immediately, and then about 5.2 of that is total for year one. And then if we're looking at like how that actually is applied, if you're at a 25% tax rate, that's about $2.24 million in tax reduction versus $1 million in tax reduction if we're only capturing that 40%. So it's massive. Now, why do real estate investors like that coming back? I think it's obvious. If you can make investments strategically and capture a lot of that depreciation up front, now you're doing two things at once. You're getting money to work, so you're making an investment based on the return, and you can start playing the game that you're able to capture a lot of loss up front to help you offset additional gains that you may have. So you start playing the tax game plus the return game. Some of the pushback on that. Anytime we talk about tax incentive, I think there's probably a few things at play. One, most people feel like tax incentive is only for the wealthy, so it's not fair for everyone else. And there's a third part of it that is actually true. The tax code incentivizes the business owner. It does not incentivize W-2 income. And because most people are employees, depreciation doesn't offset the actual income that you're taxed on yearly. So you don't feel like there's as much benefit versus if you're a real estate investor. Because if you're a real estate investor or a real estate professional, you're able to actually use depreciation loss to offset your ordinary income. Yes, that's an incentive given to real estate investors that W-2 doesn't get. Now, how I've always, let's say, squared that, or why I think this is actually a good thing to promote, is because the tax code is all about incentives to influence investor behavior. The powers that be have learned that if they create incentive, investors act. And because the government doesn't build real estate, and because real estate is needed in our society and is a function of economic growth, this is one of the incentives that they have used to get more people to invest in real estate. Now, so what does that mean for people who are W-2 that want to make real estate investments? You still get incentive. You just get it in a different way. You get passive incentive. It feels like we're not taught this in school, that incentives are not only legal, it's kind of the whole point of the tax code. So a lot of times when I'm telling people about tax incentives, the first thought is you're doing something wrong, it's sketchy, it's almost like under the table money. That's not what tax incentive is. Think of it as simply as this. Tax incentive is created to incentivize investor behavior to put dollars into areas that stimulate the economy. So I don't think it's something you need to feel bad about. I think it's how the system was created to grow GDP. And if it's out there, take advantage of it. Now, one thing that's also coming into play with One Big Beautiful Bill Act, I can't believe that's the name of it, but that's what they're going with, is estate tax relief. So let's now go on like legacy planning. This doesn't apply to everybody, but it does apply to certain people. The bill would permanently increase the estate and gift tax exemption to $15 million per person, which is about double the current projected level, starting in 26. Now, the TCJA that was passed in 17 doubled the exemption to $12 million per person, but it was set to revert to $5 million in 2026. So this bill would keep it very high, and if you're married, it would actually double. You could get about $30 million of tax exemption. So why is this important? Well, if you're wealthier and you pass your portfolio down to your kids, well, they get a big chunk of that before they're taxed. My perspective on this one, gosh, some of these things I could find myself arguing both sides. Does this benefit the wealthy? Yes. Are kids inheriting a portfolio that they didn't build and aren't paying taxes on it? Yeah, it is. But on the other end, our money is taxed so much, like at what end does it stop? Right? Like think about all the ways that we're taxed. We're taxed, at the corporate level. We're taxed personally. We're taxed when we buy stuff. We're taxed, $1 is taxed like 7 different times. So in some regard, if you have somebody that has already paid taxes over and over and over, I'm not sure you should pay again when you die. But I'll leave this one open for debate because I can kind of see both sides of the coin here. One of the next kind of big components, and this one is creating a lot of controversy, is the SALT cap. And what SALT stands for, it's the state and local tax deduction. And what it does, it allows taxpayers to deduct certain state and local taxes, which is property, income, and sales, from their federal tax bill. So in 2018, there was no limit on the deductions. post 17 in the Tax Cuts and Jobs Act, a $10,000 cap was introduced. Now, for me personally, this one hurt me. I live in California. I'm taxed very heavy here. And so I definitely now have a, let's call it double tax at play. What the big, beautiful bill as of right now, Senate may pull this out, it's going to possibly raise the cap up to about $30,000, or it might eliminate it entirely for certain income brackets. Now, here's kind of your pushback, and it's interesting because you're getting it on both sides. This is not just a Republican pushback or a Democrat pushback. Both sides are pushing back on it. And here's kind of your 2 points. If you're in a high tax state, right, like myself, California, let's say New York or New Jersey, you're getting hit twice, right? You're paying a high state and local tax, and then you're having to do it again on your Fed. So it is a double tax. How some of the politicians are framing it, you're raising the cap as a sweetener for Democrats. That's kind of what the conservative message is. And it's a way to kind of gain support because there are other elements of this bill that are being cut that I would say predominantly are supported by the left. So this is how some politicians strategically are looking as a trade-off. Now, for the argument of fairness, supporters are saying it's unfair to penalize people just because they live in high-cost areas. So that's the frame. You're framing it as avoiding double taxation. Here's why people are against it. 80% of the people that benefit from the repeal is the top 5% of earners. So critics are saying it's a giveaway to the wealthy disguised as middle-class relief. And then the other two, it reduces federal revenue, so potentially by hundreds of billions. If you're not hitting a double tax, that's less revenue coming into the government. And then the last one, critics would say, is why are we cutting spending on, let's say, Medicaid, while also giving tax breaks to millionaires? The pushback now is it rewards high tax state governments. So if you have a state like California or New York that have extremely high taxes, critics are basically saying you're incentivizing bad behavior. You're allowing them to tax like crazy with no repercussions. So they like the idea that if a state is going to have high local taxes or state taxes, that in theory should put pain onto the residents. The residents would be frustrated, vote basically people out to make the state basically a lower tax state. That would be maybe the holistic approach. On this one, for me, in the beginning, I stated I'm not sure yet, but I'm kind of leaning towards get rid of the cap. Look, I don't like being double taxed. I don't like paying a crap load of taxes for living in California and then having to do that again on my Fed bill. I'd rather be able to use the deduction that I'm paying for these heavy taxes and at least bring my federal tax down. But part of me also understands the holistic approach. Like if part of this bill allows politicians to tax you heavy in a certain state and the residents don't feel the implication, well, you can make the argument that some of the low tax states are now subsidizing the bad behavior of, let's say, a state like California. I think I'm kind of leaning towards that, actually. Even though that's going to cost me more money, I think I do like the pressure put on politicians that if they make policy that people don't agree with, you should have a political hit for that. I want to know your guys' opinion on that one.